Louise Bedford here, your host of the Talking Trading podcast. This is how traders excel. This week, I am about to introduce my sometimes co-host, Christopher Tate, and we're going to talk about short-term trading secrets revealed. Chris, welcome to the show.
Thanks, Louise.
Now, I know that a lot of you already know who Chris is, but I wanted to give him a very special introduction because there are some things that you don't know about him for sure. So firstly, we have been business partners for nearly half my life. So it is so bizarre to think way back when we first met, I had no idea that we would eventually be co-founders of the Trading Game Mentor Program through tradinggame.com.au. That is a mentor program that is the longest running mentor program in the world for traders. And we've been running that for the last 24 years. Chris is also the co-author of our book, Let the Trade Winds Flow, which we wrote in conjunction with Dr. Harry Stanton, the late and great Dr. Harry Stanton, and also a best-selling author of The Art of Trading and The Art of Options Trading in Australia. Now, let's remember that book, The Art of Trading, was the very first share market book released in Australia about the markets. So Chris has been around such a long time because he originally was a floor trader when we had trading floors. So we have been developing our minds together, developing our thoughts about the markets together for such a long time. And it has been a privilege to be his business partner. Our topic for today is short-term trading secrets. And I know that you as a short-term trader and a medium-term trader have so much wisdom to convey to everybody listening. The people that we're chatting about with a short-term trading mindset vary from those with a long-term trading mindset. There are some significant differences. So firstly, Chris, can you tell me what you think of as short-term trading and the type of person that excels with that time frame?
I think there's probably two definitions of what we could call short-term trading. That is those people who are intraday traders who will end the day square. So they'll open a position sometime during the day, and as part of their rules, they simply close the position at the end of the day. They don't want to carry forward overnight. The second sort of short-term trader are those who operate on a similar time frame but are willing to carry a trade overnight. Both approaches have pros and cons. The problem of ending up square at the end of the day is that you do miss the facility to have or to take part in a move that continues for some time. But you do remove the risk of overnight moves. The reverse is true for people who operate on a short-term time frame but leave the position open overnight. They have that advantage of perhaps being exposed to longer-term moves, but they do face overnight risk. And there's no perfect solution for that. But that's just the way it is. There's no way around that in any way, shape, or form. In terms of those who excel at short-term trading, they tend to be people who've mastered two domains. One is they actually understand what short-term trading is and what their methodology is. And they're actually in it for the business. Most people, and this will probably offend people, the evidence seems to indicate that the majority of people who trade short-term do so for entertainment. They don't do so for profit. They're not interested in profitability. They're interested in being part of the action. If you've mastered that, if you put that to one side, there is a second criteria that is important, and that is that notion that you somehow extract the signal from the noise of short-term trading. Short-term trading is very noise-heavy. And so if you've got your psychology organized and the capacity to extract a signal, then you've created an edge for yourself.
Do you think that short-term trading is more difficult than medium-term trading?
I think there are aspects to it that are problematic in that the moment you compress the time frame of anything, the emotional intensity of the event goes up. But use a practical example. Imagine you're trying to get out the door with 2 kids, a dog, and you've got a dozen things in your hand, and then somebody drops something else on top of you. You're already flustered and hurried. To add another sort of requirement for your bandwidth tends to overload most people. And that tends to be the problem. You tend to get this emotional overload in that compressing time frame expands out the emotional intensity. You don't get that with medium-term trading because you simply look at something at the end of the day or the end of the week. And so there is not that constant interaction and engagement. So all the little reward centers in your brain are not going off. All the little pain centers are not going off with such regularity as they are with short-term trading. And I think that's something that people misunderstand, is that they think if I do lots of trades really quickly, I'll learn really quickly. No, what will happen is you'll probably make the same mistake over and over and over again because you don't have the emotional bandwidth or space to sit back and go, I got that wrong. Here's where I got it wrong. All right, let's step back, start again. Because we come back to that notion that people are interested in short-term trading for entertainment.
And if somebody can short-term trade, does that automatically mean that they can medium-term trade and vice versa?
One of the problems with trading psychology is it can to some degree be domain specific. And by that I mean that some people have a niche and they need to play their game. If your niche is short term, then you play that game. If your niche is medium term, you play that game. One of the problems we both observed is people who try and spread themselves across every conceivable time frame in the world, across every conceivable market. And of course, quite naturally, there is not enough in terms of internal resources to be able to deal with that. You get decision fatigue, you get information overload, you get emotional overload. So whilst the principles seem the same, I think we've got to come back to the fact that people have a niche and that they've actually got to trade that niche. And it's often difficult to do that in the presence of things like social media, which say you must be trading this instrument in this time frame to be profitable. To use a technical term, that's bullshit. It's simply not true. It's a matter of find your niche, work your niche, understand where your edge is.
Does it start where people think about their trading objectives first and then work backward to work out which market to trade and which time frame to trade? Or should people, when they're starting, just try a variety of time frames and see what suits them and what sits well?
I think one of the problems that people face is that too many people begin trading with the expression, I'll have a crack. And of course, that always goes so very well for everybody. It is a little bit like, the analogy I use is fat middle-aged dad sitting on the couch watching the Olympics, looks at the men, let's say the men's gymnastics, particularly the rings, which seems unbelievably hard, and they go, I could do that. Why not?
How hard can that be?
How hard could that be? Well, given that it's only done by 0.0000001% of the world's most gifted athletes, I'm guessing pretty friggin' hard. And so what happens is that people don't actually understand their own limitations. And limitations come in the form of the time you've got. Because I've shared this story before. I had a conversation with a person many decades ago. And I said, right, what are your reasons for trading? And they said, well, what I want to do is buy freedom. And that's quite natural. That's quite understandable. Money buys freedom. It's just the way it is. It is one of the joys of having money. And I said, so what do you want to do with this freedom? And he said, well, I'd like to spend more time with my family. That'd be really good. I said, okay, how are we going to do this? And he said, well, what I want to do is I want to intraday trade FX using tick charts. Game's contradictory. Aim and outlook are contradictory. If you want to intraday trade currency using tick charts, then your day will start when the European evening session begins. which is early evening our time, and it will go all night. And it will end when the US closes. So how are you going to spend more time with your family? What you need to do is to match what you're capable of doing with what you want to do. You might want to do all sorts of things, but simply not have the facility to do so. If you have a full-time job that occupies you intellectually and is a drain on resources, your chances of being a successful short-term trader are very small. It's very difficult to build a methodology that would fit in around that sort of lifestyle. Yes, I know there are people who go, all I need to do is to trade for 10 minutes a day. Okay, which 10 minutes? And what happens if the market doesn't present opportunities during those 10 minutes? What happens if you're in the wrong market at the wrong time? And this tends to be the problem with people. They tend to be wrong market, wrong time. And you have to pick the market you want to trade and then understand the time frames under which it operates. If you want a short-term trade ASX stocks, well, your day will begin here in the eastern states at 10, end at 4. It's just the way it is. If you've got a job that runs 9 to 5, you've got a real problem because you've now got this conflict. And I don't think many traders sit down and think about what they can actually do, what markets they can trade over what time frames. They just see on the internet some peanut doing something, saying they've done something, standing in front of a Lamborghini they've rented for the day, pretending they bought it, saying, I bought this by being able to day trade 5 minutes a day. If you fall for that sort of thing, well, you tend to get what you deserve, but you've got to understand your limitations. It is just the way it is. We all have limitations in what we can and can't do. And once you understand the limitations, that sets the upper boundary of the domain. So you then work backwards and go, well, I have these limitations. These markets are open and available to me over this time frame, given my limitations. And it has to be this top-down approach of understanding actually what you're trying to do and how you're trying to do it.
And maybe even one step back would be to work out your values. So is what you're aiming to do as a trader fulfilling your deepest values? Because if you're working in conflict to your values, there are ways that you'll find to self-sabotage yourself and shoot yourself in the foot. So maybe if we're putting it in terms of the hierarchy, it would be values, objectives, lifestyle limitations, and then choose the time frame that you could possibly trade. Would you agree with that?
We come back to that awful notion that the higher level criteria and domain for trading is always psychological. It is always understanding who you are so that you play your game, not somebody else's. One of the keys to success in anything is to play your game, not somebody else's. As an aside, there is a hedge fund, BlackRock, the largest in the world at present, run by Ray Dalio, who's a bit of an eccentric character. But he did something very interesting with his staff. He had them all print up what were effectively baseball cards, the cards that kids would trade, football cards and the rest. And on it would have an introduction, their name and what they were good at. So if you were involved in, say, quantitative analysis, and somebody from the sales team came down to you and said, right, I need you to do a sales presentation, they would pull out the card and go, mate, I'm a quant, bugger off. Find somebody who can do it. It is that understanding of what you can and can't do. And that comes from an understanding of working out who you are, what you want to do, and what you want to do with trading. People have strange ideas about what trading will do for them. And they tend to mature and alter over time when they realise that the things they wanted it to do are not the things it can do for them. And it's not really the things they wanted it to do.
So that would be one of the key mistakes, not having your trading time frame match your personality and limitations. What would be some of the other mistakes that short-term traders make?
They tend to be functional in nature, in that what happens is a short-term trader will open up a 5-minute chart and just stare at it myopically. and it is difficult to extract signal from that noise. There is a complete misunderstanding of how trends work. If you're trying to go long, let's say on a 30-minute time frame, in a market that is going down weekly and daily, your chances of success are pretty much zero, because you don't understand what the higher order time frame is doing. And one of the biggest mistakes I see in short-term traders is they simply stare at their time frame thinking that conveys every piece of information they'll need to know. No, that's only part of the puzzle. There is a much, much, much bigger part of the puzzle, and that is what the overall trend is. And we come back to that boring notion that if you're not trading in the direction of the trend, then you're pushing against the tide. It's a little bit like long-term stock traders who attempt to go long in a bear market. The chances of success are very, very small. So it tends to become functional in nature. But the problem with that is that they're simply looking at the noise. The signal is given by the higher order timeframes. Now all you're looking for is a reason to take a trade on that lower time frame in the direction of the existing time frame. If you've got these countervailing time frames working against you, then good luck, have at it, or as we say in the business, have a crack, see what happens.
So looking at the higher order time frame and making sure that you're in line with that primary trend is really important. What about some of the psychological things that short-term traders have play on their mind and that can scare them out of positions and perhaps not make them perform the way you'd hope to perform as a short-term trader?
I think we drift back to this notion of noise. One of the problems with short-term trading is it's wonderful dopamine little affliction that we have. Things are always happening. There's always numbers changing and things flashing on the screen and stuff's happening. And you feel like you're actually doing something. You are doing something, except you're not making any money because you're involved in the process of engaging with the noise, because the noise is giving you a compulsion to do something. Once you feel the compulsion to do something, you're on the wrong path. It's very important for people to understand that you pick the time and the place of the trade. The market doesn't pick it for you. And so you sit and you wait. And we come back to the very boring sort of notion of patience. Patience is free, but it is the most powerful trading tool you can have, because you sit and you wait, and you sit and you wait. There is this notion that short-term traders have that they must always be active. But I've known short-term traders who will, let's say, fire up the screen at 10. If by 10:15 nothing is happening, they'll go and play golf. The screen just shuts down. That's it. And they also do the same thing when they encounter a loss or a sequence of losses during the day. They will have a threshold point. That threshold point is a cutoff. If they're down 1R, 2R, by 11:30, the day's over. They will once again go and play golf or go out for lunch or go and do something else. And it's necessary to have the discipline to adhere to these cutoffs. If the trade's not there, the trade's not there. You can't make the market give you a trade. So if you're, let's say, fixated on, let's say, an ASX gold stock, and your expectation is, let's use the notion of an earnings report. Some sort of report comes out at 10:15, you're expecting that, you're good to go, nothing happens. Go home, switch the screen off, go do something more productive, because it's not going to happen. That opportunity has passed. That environment that perhaps offered that opportunity is now gone. That window's closed, so it's a matter of just switch the system off, go home, go do paperwork.
The hard part, though, is that some of our traders are trading for a prop firm. So the prop firm is the firm that gives the trader some money, and then when things go well, the trader gets to keep their job. So it is so significant that they continue to perform. And a lot of these firms have a leaderboard as well, so that you can see in order who is doing better than you. I think that can be something that can play on traders' minds. And I'd love to hear your thoughts with that. It does seem to push traders into a more short-term mindset, but where that they perhaps are not equipped to be able to handle that. If that short-term trader is feeling like they're competing with other traders, what would your thoughts be and your advice be to them?
Stop. If that is something that is of overwhelming importance to you, then you're in the wrong place. You're in the wrong place probably physically, you're in the wrong place emotionally. The simple fact is you always have to come back to it. I'll use a different example. I recently did a video on ETFs, exchange traded funds. So we're talking about a different end of the time scale at present. People tend to trade ETFs over a long term. One of the things that people don't understand is that the ETF is created as a wealth transference vehicle. It's designed to transfer wealth from the investor to the people who run the ETF. That's why there are so many of them. I think from memory, there are now more ETFs than there are listed stocks in the US. There's an ETF for all sorts of things. There's an ETF over whether the next toaster I will buy will be red or blue. It's that stupid. When you deal with a prop firm, you have to understand that you're an employee for a firm that is trying to make money. So they're attempting to do things that might run contrary to your basic psychology, that they do engender this compulsion, this notion that you must force trades as opposed to simply sitting there and waiting. Because one of the things that is not understood even about short-term trading is that the returns from a trader are lumpy, and they're lumpy over all time frames. So it is quite possible as a medium to long-term trader to make no money for 10 months of the year, then make all of it in 2. It's quite possible as a very short-term trader to make no money for 28 days of the month and then make all the money in the last 2. But if you can't control yourself during those previous 28 days and you don't blow yourself completely out of the water, then you won't be in a position to take advantage of those 2 days that present an opportunity. You're simply caught in this awful maelstrom of being forced to do things, of forced activity. And activity is not profitability.
So you're saying run your own race, play your own game, try to separate yourself out from the others around you. It does remind me of that Nicholas Darvis book, How I Made $2 Million in the Stock Market. It's an exceptional book, there is no doubt. So Darvis was originally a ballet dancer and became a trader on the side, made so much money out of trading, he thought, well, what the heck, I'll take an office where my broker has other traders trading and I'll try and trade there, because if I'm making so much money when I'm not looking at it every day, surely I'll make more money by sitting with the other traders. And because he started comparing himself with the other traders, it ended up having a very detrimental effect on his own trading results. Is that something that you think would be a typical journey for a lot of traders, Chris?
This is why hedge funds quarantine their dealing teams. So they actually split them physically so that they don't cross-pollinate and they don't infect one another, because it doesn't have the effect that they think it would have. They've worked out that you need to let people do their own thing in their own time and just leave them be. If you generate some form of compulsion for them, what they tend to do is take stupid trades and blow themselves up. And if you're working for a hedge fund, it means you blow the fund up as well.
And there is an aspect of emotional contagion. So when you walk into a room, often you can tell the most negative person in that room because you can feel their energy suck, their drain. And with traders, we can face a similar thing. If you've got somebody overly jubilant, overly excited about their own results, then that can actually impact you because you're thinking they're doing so well, I'm not doing so great. I'd better lift my game instead of running your own race. So I think we do need to be aware that emotional contagion can actually spread through forums, through Discord, through aspects that aren't, even if you're not face to face with somebody, even if you're not shoulder to shoulder with somebody, you can pick up on things from the news, and that can impact your own mindset. So is your advice to be in that situation to try and separate yourself off?
You sound like a bouncer.
You are a bouncer. You used to be.
Because the job of the bouncer was to take the sting out of confrontations, to not be party to the confrontation. The moment you become party to the confrontation, it escalates, and if it escalates, it gets out of hand. If you can take the sting out of these things, this is why even now, having taught combatives and for 1,000 years, the aim is de-escalation. Do not become part of the problem, because the problem will create enough problems of its own without you adding to it. Same's true in trading. You've got to step back and not become part of the problem. And when you're surrounded by other people, that becomes problematic. They tend to, humans are herd animals. When I was much younger as a student, we used to do this thing where on the way home from university, you'd stop at a city corner and a group of you would stand and look at the top of the building. All of a sudden, everyone would stop and look at the top of the building. I've even done it to play funny buggers with my neighbours, and I put the bins out on the wrong day. Strangely enough, all of a sudden the street becomes full of bins. Because humans are herd animals, we want to be part of the herd. We are affected by the emotions of the herd.
You are the bin alpha male.
No, I'm just the dickhead down the road that makes the piss out of people. It is that thing, you're caught in this whirlpool of other people's emotions. And that's not where you want to be, because their game, their race, their life is not yours. You have your own. We're back to play your own game in terms of strategy, technique, psychology, emotion, values. They're all yours. Sit with them and deal with them.
So do you think people should only short-term trade if they think that that is their sweet spot, or should they spread themselves through other type of trading timeframes?
It is very, very difficult for a short-term trader to compete over the longer term in terms of wealth creation with someone who, I'll use an example from the past 2 or 3 years. Chalice mining, 15 cents to $10. De Grey, the same. Liontown, the same. How many trades did you take? 3. What did you make? Oh, look, I probably lifted the account by 5-fold in 2 years. So you only did 3 trades. Now, I call it 6 if you count the exits, to be fair. It is very difficult to compete. You may convince yourself that by making 0.1 of 1% every day that you're going to have this aggregate gain over the year, but you won't, because that's not how the continuity of returns works. They just don't work that way. So it is extremely difficult to compete with someone who goes, lithium stocks are booming, I will hit those out of the park, because they offer such outsized gains in such short periods of time. And we're seeing, as we record this, there has been a similar bubbling in local gold stocks. It's very difficult to compete with someone who has traded wildcat successfully and has generated around an 800% return on the trade. That's an awful lot of short-term trades to catch that person. We have members of our boardroom who have engaged in block trades on the TQQQ, which is the
NASDAQ.
NASDAQ 100. And in single trades, they've made millions. It's very hard to compete. It is so hard to compete. And I think I can only offer my perspective. For me, short-term trading is a cash flow endeavor. It generates cash flow that then flows into the longer-term system. So it funds and powers the system. It would be very difficult for me to generate what I do just churning over commodity markets like I do without taking outsized risks.
And one of the strategies that we suggest to members of our mentor program is if you are looking to short-term trade, separate that out into a separate portfolio so that you've got a chance to be able to immerse yourself with that mindset while you're short-term trading, and then go away, have a break, and then do your medium-term trading duties in a separate portfolio. Try not to let the two play together because that can really foul up your mindset. Any parting advice, Chris?
You don't want to come across as negative on short-term trading because it obviously works very, very well for some people. And it works very, very well for those people who have sorted out their hierarchy of their business. They understand why they're doing it. They understand what the aim of doing it is. Those who've simply kicked off because they've seen something on the internet or they've read about prop trading or they've seen something on social media will tend to struggle because they haven't worked that out yet. The trick for them is to try and survive long enough so that they do work it out. And if there was a functional aspect that contributed to an edge, because all traders need an edge. Without an edge, you will go broke very quickly. It is to understand how trends work. The trend just isn't the 5 minutes in front of you. There is a much, much broader background to it you actually need to understand. If you don't understand that, you're constantly swimming against the tide.
How can people get in touch with you?
I can be found at tradinggame.com.au. You can find me on Twitter under our handle. You can find me on LinkedIn under my name.
Chris, thanks so much for your time. I have just loved talking about short-term trading strategies. Happy trading.
See you.